Hey, what's up, everybody? It's Matthew Mickey here from Trading for Veterans and Service Members. And today we're going to go over the other way to measure historical volatility with average true range. But before we do that, why am I preaching volatility? Your first step to learning the business agenda of a professional trader. Well, I need you to understand how to build your studies, risk plan, and trading plans around that. Now, before we get into it, you might have heard of different types of traders. You got swing traders, day traders, scalpers, hedgers, bananas, like crypto pump and dumps. Like, it doesn't matter. At the end of the day, I'm going to go over a couple, different organizations of people who are in this market. And, we are going to design our professional trade and business plan around them, because at the end of the day, you're the CFO of your own money. And do you want to follow some idiot on YouTube that supports veterans, or do you want to align your trading up with how they do it? All right, so let's start it off with talking about the wholesale side of things. The wholesale side of things are your investment banks, right? And they are your sell side. So their whole job is to build markets, right? These guys are the dealers who provide the liquidity in the markets, and they work for large institutional banks, and mostly 90% of the time they sit in a boring room and babysit an algo, and 1% of the time they get to trade the bank's funds because they are not neutral on a certain deal they have with a client. All right? And, I'm going to teach you how they build this market through the futures part of the course. And they're pretty much overworked. So people don't stay as market makers that long, like 3 to 7 years. Then we have pension funds. They're the buy side. They've raised funds smartly. And at the end of the day, we all end up relying on them. And then, okay, let's talk about hedge funds. Hedge funds are my favorite one. And why is that? Because they're like a team building, closest thing to what I'm used to anyway, right? And if conducted right, this relates more to how I trade than anything else. Now, what they do is they raise capital and clients, then they take different approaches to analyzing, where the market is that they're trying to target. They use macroeconomics, global views, sectors, etc., etc. And then they pitch it to clients to throw capital at them. And those clients throw capital at them, and how it works is the clients agree to a 3% maintenance fee, which they cover staff and office stuff with. And then the client also agrees to 15 to 30% profits. And then that hedge fund takes that profits, and they don't go buy Lamborghinis with it. They don't go, have a nice steak dinner with it. No, they understand the importance of compounding growth and managing your risk based off of your growth. So they reinvest it into the firm. Most of them have a contract with their clients saying that this much profit will go back into the firm's fund, and that's how they do it. And then, they target everything. All right, so now we have propriety trading, and these are your quick traders, like the buy side as well, the professional risk takers. I'll be teaching you that in the currency forex market of how they operate. And then you got us retail traders. We're the buy side. We're too cheap to give the team on the right side of this chart and eventually give them our funds anyway. And we're going to take a professional trader's approach by aligning our trading plans, our risk plan, our study plans, more so with the hedge funds and the proprietary trading. Like as you saw in the volatilities classes I talked, there's a time to be a portfolio manager and there's a time to be a short-term day trader, right? And so 80% of the time, as we saw in the S&P, we want to be a hedge fund manager that manages a portfolio and tries to grow capital the smart way. And then when volatility picks up, we want to shift We want to de-risk and shift our focus over to proprietary trading. Now you might be asking yourself, like, what are the odds of you doing this? Well, it depends on how much work you put into it. I've seen a lot of people make a lot of money. I've seen a lot of people lose a lot of money. I've seen a lot of people succeed at times, and I've seen a lot of people fail at times. It's not about if you're going to pass or fail. It's about when you get knocked down, do you get back up again? And then you might be asking yourself, well, why would I listen to you, Mickey? You have no experience in any of these firms that's on the chart. You're right, I don't. But I've spent a decade journaling, studying, and having the flexibility to study every type of market there is. So, and I've also have sought mentorship through multiple people coming out of each one of these funds. And, I've spent thousands and thousands of dollars on education, learning from, the guy who got sick of JP Morgan, got out, just had to put together a course and charge people thousands of dollars on it, So the whole reason I'm doing this is so you don't have to spend thousands of dollars. You don't have to read hundreds of books like I did to pull all the fluff out. And, I'm trying to give you guys structure. So moving on to ATR. So ATR is another way to see historical volatility and align us with the type of traders we need to be by calculating the high and the low for a day, week, month, quarter, or any time horizon. So we can understand our expectations of where we need to place our stops, our profit targets, where we need to enter at, and what type of profit and loss we can expect for the time period we decide to trade. Now, we said the beast is sleeping in the first class. We want to structure our trade as a portfolio manager. We have already seen that trying to day trade when the beast is asleep has the odds stacked against us. So we extend our time and trading strategy out to increase the odds. By doing it, we can do it a multitude of different ways. We can do it by intermediate swing trading, breakouts like Oliver Kell does, or manage 1 to 3 month portfolios like Darius does based off of economic factors. We can do 6-month interest rate swaps on the Aussie Yen pair like Chris Laurie does. However you want to approach your portfolio management is up to you. But I will tell you should conduct talent management on yourself to see from a psychological level what type you should be at. You should try. Then try them all on a paper trading account and journal and use the Kelly criteria to see which one you're most successful at. Either way, we trade the 80% of the time while the beast is sleeping. We must always use volatility and a worldly view, economic view, industry view, company view, and news headline risk, along with the data systematic approach to give us the clues we need to see when the beast wakes up. That way we can de-risk, Now, ATR measures the high and the low. Now we have measured measurements of the open-close historical volatility and measurements of the high-low volatility, and we've learned how to calculate implied volatility. Now we look at all the different time horizons for ATR to see what the rolling true range is now. If we look at this before quantitative easing really became awesome, we would see that the true range decreased over time and increased as time went further out, meaning less volatility, taking a lot of short-term opportunities out of the market. This was caused by a multitude of reasons. Algo trading kicked in, and really hit it off. And not just to buy and sell orders, but, they built algos to predict order flow. That way they could buy, jump in front of the wholesale, and sell to the order flow. And then they built algos that countered those algos. So you're fighting a robot. Then, obviously, we had more market participation happen during that time in 2012. And, that sucked up a lot of liquidity. the tail risk that we discussed in, class 1. Tail risk comes out of people's portfolio, volatility will drop. And then, central bank, actions like in the bond market and in the options market, they, during this time, were selling volatility to keep it low. And then, doing what they do in the bond market, which we'll discuss in further classes. Now look at volatility for now. Short-term volatility has picked back up, giving us more opportunities in the short-term time horizon. Now the next 3 classes I will do the workshops to show you guys how to build these spreadsheets. So starting off, whether you take any more of my classes, you know how to build realistic expectations. And if you go into the market using these 3 tools, you are using stuff that does work, and you know what to expect. Now, if the market you are used to trading isn't working with the volatility, go hunting for your ideal volatility market. All right, guys, I am excited because after this, we get to learn how to start taking a top-down and then a bottom-up approach, and then we can start talking about how to hunt for the trades and do ideal generation. All right, later.